the third quarter of results, a whopping 41% of corporate debt is with companies whose earnings are less than their interest outgo. This dramatic conclusion comes from Credit Suisse's analyst Ashish Gupta, who has been tracking the debt of 3,700 listed companies amounting to about 30 lakh crore rupees. In June 2014, when Credit Suisse put out its earlier report, 36% of the companies were in this state, where their earnings were less than their interest. What does this mean for banks who have lent the loans? First, while total gross NPAs or loans in default stand at 9.5% of total loans given by banks, Credit Suisse says a further 4 to 8% of the loans are stressed. That is, they are restructured in some form and could go into default category or NPA in the next 18 months. Secondly, under Indian rules, banks have to provide for NPAs in a calibrated manner. 15% in year 1, 25% in year 2, 40% in year 3 and 100% in year 4. With NPAs aging, banks will be faced with 86,000 crore of additional provisioning next year only for loans already recognized as NPAs. Given the poor state of corporate and bank balance sheets, is it possible for the economy then to grow at all? Will growth help these companies and banks overcome their stress? Or will an extra banking initiative be needed, like a bad bank? To answer these questions, I have with me the author of this seminal Credit Suisse reports, Ashish Gupta. Ashish has in the past 3 years become a source of data and advice to both the Reserve Bank and the government. Ashish, thank you very much for joining us. Well, first up, your report says that of the 30 lakh crore of corporate advances that you track, 41% are with companies who are not making enough money to pay the debt. But can we at least be sure that this number is the peak, that things are improving with, say, steel prices rising, etc.?
Okay. So, actually, our observation from this health tracker is a bit of a disappointment, because what we were hoping for in the last 6-9 months is that we should see some relieving of stress levels in the banking system and in the corporate sector, given the rally in the commodities and in particular the steel sector. Because as you know, steel has been a large component of NPAs banks have had to recognize in the last 12 to 18 months. But frankly, that has not been the case. And the reason for that have been twofold. One, that the recovery in the steel sector has been limited only to a select few companies. Some of the over-leveraged companies continue to have their EBITDA levels much below their interest cost. And still what we find is 52% of steel debt is sitting with companies with interest cover less than 1. And of course, this is better than around 60-65% 6 months ago. The second reason why we have not seen stress actually improve but actually deteriorate slightly over the last 6 months is that in other sectors the problem has continued to deteriorate. And two sectors that we have particularly noted is, one is the power sector, where the stress over the last 6-9 months for most of the generating companies had deteriorated. And if you even sequentially look at their EBITDA generation, that has continued to drop. And more lately, even the telecom sector has seen their interest cover fall below 1. And if I see power sector now, 67% of power sector debt is with interest cover less than 1, and about 45% of telecom debt now has interest cover less than 1 in our sample. And that's been really the broad finding of this health tracker, that while overall corporate profitability has not deteriorated, but companies that are under stress, companies that have interest cover less than 1, every quarter they are still seeing their EBITDA contract.
Let me take your list of 100 top stressed companies. Now, this has in your list Tata Motors, Adani Power, SAIL, Steel Authority, JSW Steel, Tata Teleservices, Kesoram, Reliance Defence. Now, all these may not default at all because of the sturdy parent groups that they belong to. Should you actually be putting them in your list of, your 41% stressed loans?
Yeah, so that's right. So we really don't really imply that all of this. So the table you are looking at are companies that have interest cover less than 1. So we are not really looking at all companies that have interest cover less than 1 turning NPLs for the banking system. And we are only looking at a subset of these companies. And these are primarily companies or assets that have been under chronic stress for 2-3 years. Right. So some of the names that you have mentioned have had an issue or the slip up just for a quarter or two. So that's really not an area of concern for us. So in our health tracker, the total magnitude of debt that has interest cover less than 1 comes out to nearly 40%, right? So, but we are not saying that 40% of bank loans are NPAs, right? So our estimates for bank debt that is stressed is about 16-17% of their total debt.
Okay, currently gross NPLs or GNPAs are 9.5% of total bank loans. What is the worst it can go to?
So now on top of that 9.5%, you already have a piece which is restructured, which is another 2.5% or so. On top of that, already there are the SDR kind of structure. So there are various tools that RBI have provided and banks have used for the assets. And if you add all those pieces together, already that number is for the banking system is close to about 14%. Right. We believe the total amount of the stress could be somewhere around 16 to 17.
So, in the Q4 of FY18, that is next year, will we be staring at some 16 to 17% GNPAs?
All of it may not turn NPA, and many of these forbearances provide a standstill in terms of recognition for 18 months or so. But I think clearly we will be somewhere midway between 9.5% that we have today versus the 16-17% that we are talking about. And also just to point out that the numbers we are talking about are the aggregates for the banking sector, right? And within this, if you individually look at banks, there are already banks where the gross NPA number is close to 20%. Aggregate state-owned bank number is already in double digits. So there are pockets of the banking system where we are already seeing numbers of this magnitude.
Okay, the midpoint of 9.5 to 16.5% GNPA. So let's take 13%. When do the GNPAs get to 13%? Will that be in FY19 or 18? For really working out what is the percentage in terms of peaking out, you also need to keep in mind the denominator, right? And that is how fast the overall loans grow. So if overall loan growth does start to pick up, let's say sometime during next year, then hopefully in terms of percentage terms, we peak out sometime next year. Yeah, Ashish, the economic survey says that from the second half of 2016, even small and medium companies which were running a tight ship have started defaulting. Your 13% GNPA number includes this category as well?
So the 13% number includes the MSME pain to the degree it has already been recognized by the banking system. But really, we don't have data to do any forward-looking analysis of those loans. And therefore, in our forecast, we are not really building in incremental addition from there.
Okay, so that's a fairly serious problem. We'll do one thing. We'll take a break. We will come back and discuss some solutions to this huge corporate and bank stressed debt problem with Ashish Gupta.